volatility in the new year. Futures pointing higher after the markets took a nosedive yesterday. Driving the action today, China confirming another round of trade talks early next week. China's central bank taking action to pump money into the economy. Joining us now is fixed income advisors, SIT. Fixed Income Advisor, Senior Vice President, Portfolio Manager Bryce Doty. Bryce, what are you watching for today in this jobs report? What will be good news?
I think it's...
if we get too much good news, is it going to be bad for the market?
Right. Good news is bad news. I was just going to say I think you could easily get a jobs number over 200,000, but do you really want it? You have to be careful what you wish for. If it's too strong, everyone thinks, oh, no, now the Fed's going to be back on track for raising rates, and then this short-lived uptick in stocks will be evaporate in a second. So you almost want a jobs number that's close to expectations with hardly any additional wage gains. But I think that there's some real risk that a positive risk that the jobs number will be pretty strong. Now, the impact on the markets, as you say, that could be very counterintuitive. You could have a strong jobs market and see the stock market take a hit.
Bryce, it's pretty fascinating sitting here at the start of 2019 and seeing where the 10-year Treasury is and actually expectations of where the Fed's going to go for the rest of the year. So seeing where we got a 10-year Treasury below 2.75 boggles my mind, especially where we are in the economy. Do you think we're going to get some reprieve in the short-term 2-year Treasuries because people are starting to go to cash? I think one of the reasons why we're seeing volatility in the market is because you do have alternatives. You're getting high yield that we haven't seen in years from just short-term paper.
Right. Not only are you getting decent money market returns for the first time in over a decade, you're also seeing corporate bond yields actually rise. So the 10-year Treasury is pretty lousy. I mean, I'd rather be in cash than a 10-year Treasury, given that they're almost the same yield at this point. And yet you can get over 4% in an investment-grade corporate bond portfolio. So what do you do as an asset allocator? You've been way underweighted bonds for who knows how long, right? And now you can actually get a decent amount of income. All of a sudden, bonds become an asset class again. So you start allocating from stocks to bonds, lower the volatility. That creates some disruption in the stock market as people start to do that. But I think it makes sense to do a combination of T-bills or cash or something like that and some corporate bonds versus just being 100% or 80% in stocks like it seems like people have been for a long time.
Bryce, Deirdre here. I'm just curious, how much risk do you think is actually in the corporate bond market right now? Because according to a lot of people that I've been speaking with and pieces I've been reading, it seems like we are fairly heavily over-levered, almost in a way that we haven't been since something like 2012.
Well, the real problem to me is that it feels like there's this huge sucking sound of all this money coming out of high yield, out of stocks, emerging market, bank loans, and going into the government bond sector because there's this massive supply-demand void that needs to be filled. You've got the Fed reducing the balance sheet, which means they're eliminating $500 billion a year worth of demand for government bonds. At the same time, the Treasury Department is adding $1 trillion worth of supply a year. So it's this huge beast that needs to be fed $125 billion a month. That money has to come from somewhere to fill this void. So that's the risk with corporate bonds. It's not default risk. The economy's fine. You're not going to see companies fold. But the fact that there's this massive draw of money to fill this $125 billion gap, every single month, that leaves a mark.
I suspect if you look at what the Federal Reserve has done, and again, the last message from the Fed, even though market expectations have changed in terms of rates being steady next year, if not lower, but the Fed was pretty clear that they are on track for 2 rate hikes next year and autopilot on the balance sheet reductions of what has been about $50 billion a month. That being said, it looks like the Fed is actually acting preemptively, and I might be off base here, but burst some of these bubbles, basically deflate some of these bubbles that you've seen, Deirdre, because we talked, that was an excellent question about the corporate debt and the debt that corporations have taken on in this country, whether it was even Bitcoin, Kevin. These technology stocks were very bubbly looking in terms of the valuations. And I want to ask you this, Bryce, because Jay Powell is speaking later this morning. Kevin sat down in Atlanta. I mean, that's going to be, people are going to be on pins and needles ahead of that, even if, regardless of what happens in the jobs report.
Right, and Powell knows that you're right. You know, there was a bubble, but corporations paying 2% and 3% to borrow money is way too low given the risk of any business. So even them paying 4.5% is still, you know, attractive. Powell understands that things were being propped up and manipulated by central banks, and we need to kind of get away from that. But he's in a lose-lose situation, okay? I don't know any Federal Reserve chair that is going to be popular raising rates or tightening monetary policy, especially with politicians. So no matter what he says, I think the market is going to criticize him for something, because he's delivering, medicine that's good for the economy. It's good for markets, but people don't like it because it comes with additional volatility. It comes with, the fact that corporations have to pay a higher rate now. I mean, they're obviously not happy about that.
That Powell, the event he's participating in down in Atlanta, he's going to be in a discussion with individuals, including Janet Yellen and Ben Bernanke. So that'll be a barn burner. Again, because it looks like Powell is and his Fed, even though Janet Yellen did start hiking short-term interest rates, it looks like that he's trying to do something that Alan Greenspan failed to do and that Ben Bernanke failed to do, and that's like putting out a bubble before it gets so large that it puts the financial system at risk. Richard, you have a question for Bryce?
Bryce, question for you. So as we're talking about central banks, with the news that Dagan started the segment with about the fact that China is putting $116 billion in central banks, and knowing that China is looming heavy on the market, does that scare investors? How do investors feel about the fact that does that mean that this trade war is going to continue? These negotiations mean nothing if they're sort of bracing for longer term impacts?
Right. I think it's a positive thing that they're doing that. I think that trade talks, are progressing. I think that's going to probably end well. But I think the market doesn't seem to care about good news. It always takes the negative side of it right now. It's a sentiment shift from just 2 or 3 months ago. So I think your concern is well-founded that they'll look at that as like, uh-oh, things must be really bad there, rather than seeing it as, oh, this could be good. It'll help the growth, help them rebound a little bit. Everyone's taking the negative side of that, the negative view of that, and I don't necessarily agree with that. But when you see that type of dislocation, I think of it as an opportunity. Talking about bubbles and going back to where markets are at, I feel a lot better about where the stock market's at. I feel a lot better about where corporate bond yields are and spreads are than they used to be. So in a sense, this bursting of the bubble is very helpful and puts us at a better valuation for most assets.
Is there anything the White House could say to investors on China to sort of ease the pressure that's happening on the market?
Oh, my gosh. I mean, the less they say, the better. Oh, it's killing me.
Well, Bryce, on that note, I'm going to say thank you and goodbye. But I will say I have said that for 2 years. And I've said it more and more in the last year, that the more of these advisors you put out there who are kind of like far afield and saying whatever they want to, when you have one of your trade advisors talking about if the Fed just gets out of the way, it's going to be the next leg up in the bull market. Why are you talking about the stock market? Why are you talking about tech stocks and the central bank when you're a trade negotiator? So anyway, I'll leave it at that. Bryce, thank you so much, Bryce Doty. Coming up